Welcome to the lecture on short-term financing, and after this lecture we will be able to learn the following objectives. Understand short-term, medium-term and long-term financing, explain the concept of trade credit, describe advantages and disadvantages of short-term financing, explain the sources of short-term finance, discuss on installment credits, define the merits and demerits of short-term finance, explain the relative merits of trade credit and bank credit, define advantages and disadvantages of bill discounting. Short-term financing is that form of financing which embraces borrowing or lending of funds for a short period of time. It refers to the finance obtained on short-term basis, usually 1 year or less in duration. Short-term finance is secured for financing the current assets, for example, inventories. Short-term finance is also known as working capital, which is the axis of current assets over current liabilities. Practically all enterprises use the short-term credits as sources of finance. The size of business has an important bearing on the use of short-term finance. There is variation in the use of short-term finance between the large and small-sized business establishments. The purpose of this study is to determine whether the matching principle fully explains the amount of short-term debt financing that a firm employs, or if factors that affect the amount of long-term debt financing that a firm uses also affect the amount of short-term debt financing that a firm employs. Short-term, medium-term and long-term financing. The basic difference among these financing schemes is a repayment term or maturity period. Short-term financing schemes have repayment periods of less than 1 year. These deal with short-term credit which may either be secured or unsecured. Secured credit are those which require a collateral backing, while unsecured credit or clean credit are those which have no collateral requirements. Medium-term financing schemes are those with a maturity period of more than 1 year but less than 5 years. Long-term financing schemes are those with maturity periods of 5 years and more. Trade credit. Trade credit is a kind of business credit which is extended by the seller of goods to the buyer of the same at all levels of production and distribution process down to the retailer. Trade credit is used by various agencies operating in the trade channels between the producer and the retailer. Trade credit has been defined as a short-term credit by a supplier to a buyer in connection with purchase of goods for ultimate resale. The credit accepted for the purchase of goods which are consumed by the purchaser is not trade credit. It becomes consumer credit. So a credit, in order to be designated as trade credit, must be extended in connection with the purchase of goods which must be resold. Advantages, reasons. We use trade credits. Following are the advantages of trade credit. It increases profit, convenience of informality, flexibility, less risk, less costly, the only source existence of business. Disadvantages of trade credit. Disadvantages of trade credit are as follows. Cost of trade credit, frequent maturity, insolvency. Advantages and disadvantages of short-term financing. Following are the advantages of short-term financing. Easier to obtain. Short-term credit can be more easily obtained than long-term credit. A firm which poor credit standing may be unable to obtain long-term funds, but it can procure at least some trade credit from sellers who are anxious to increase their sales. Lower cost. Short-term credit may be obtained with lower cost than a long-term finance because of priority of creditors in general. Flexibility. Due to seasonal nature of business, many firms have a temporary demand for short-term funds to carry heavier inventories. Most enterprises are in constant need of short-term funds. Short-term financing is flexible in the sense that the firm is able to secure funds as they are needed and repay them as soon as the need vanishes. No sharing of control. Obtaining funds from short-term creditors prevents the inclusion of more owners through the procurement of owners' funds. This results in maintaining the position of control by the existing owners. Availability. In many cases, particularly for small enterprises, short-term credit is the only source available. It may not be possible for a small firm to obtain long-term funds because of poor credit standing. Tax savings. The cost of short-term funds are deductible for income tax purposes, while the dividend paid to the owners is not deductible. Thus, a substantial tax savings may result from the use of short-term funds. Convenience. Short-term credit can be more conveniently secure than the other types of funds. It is more convenient to pay labor weekly or employees monthly than every day. Extension of credit. Many enterprises purchase equipment, supplies and goods by ordering from a supplier with the intent of paying after delivery has been made. Disadvantages of short-term financing. Frequent maturity. Short-term credit is disadvantageous in the sense that it matures frequently. The principal must be repaid when due, otherwise the creditors may close the business. The use of such credit is also a risk to the owner's investment from the inability to meet the creditor's claims when due. High cost. The rate of interest paid on short term is usually higher than that on longer term. On long-term credit is usually higher than that on long-term credit. The rate of interest usually depends on the risk involved, size of loan, collaterals, protection, etc. Sources of short-term finance. There are a number of sources of short-term finance which are listed below. Trade credit. Trade credit refers to credit granted to manufacturers and traders by the suppliers of raw material, finished goods, components, etc. Usually business enterprises buy supplies on a 30 to 90 days credit. This means that the goods are delivered but payments are not made until the expiry of period of credit. Bank credit. Commercial banks grant short-term finance to business firms which are known as bank credit. When bank credit is granted, the borrower gets a right to draw the amount of credit at one time or in installments as and when needed. Loans. When a certain amount is advanced by a bank repayable after a specific period, it is known as bank loan. Cash credit. It is an arrangement whereby banks allow the borrower to withdraw money up to a specific limit. This limit is known as cash credit limit. Initially, this limit is granted for 1 year. This limit can be extended after review for another year. Overdraft. When a bank allows its depositors or account holders to withdraw money in excess of the balance in its account up to a specific limit, it is known as overdraft facility. This limit is granted purely on the basis of credit worthiness of the borrower. Banks generally give the limit up to Rs 20,000. Discounting of bill. Banks also advance money by discounting bills of exchange, promissory notes and hundies. When these documents are presented before the bank for discounting, banks credit the amount to customers' account after deducting discount. The amount of discount is equal to the amount of interest for the period of bill. Customers' advances. Sometimes businessmen insist on their customers to make some advance payment. This generally asked when the value of order is quite large or things ordered are very costly. Customers' advance represent a part of the payment towards price on the products S, which will be delivered at a later date. Installment credit. Installment credit is nowadays a popular source of finance for consumer goods like television, refrigerator, as well as for industrial goods. We might be aware of this system. Only a small amount of money is paid at the time of delivery of such articles. The balance is paid in a number of installments. Loans from cooperative banks. Cooperative banks are a good source to procure short-term finance. Such banks have been established at local, district and state levels. District cooperative banks are the federation of primary credit societies. The state cooperative bank finances and controls the district cooperative banks in the state. They are also governed by Reserve Bank of India regulation. Installment credits. Installment credit refers to a loan of a certain amount that the borrower gradually repays by making regular payments. Usually the borrower gets the whole amount of the loan at the beginning of the loan period. Then he or she pays back the amount over a fixed period of time. The repayments cover the principal amount and the interest of the loan. At the beginning of the installment credit, the lender provides the borrower with the whole amount of money he or she needs. The lender and the borrower agree on the duration of the loan within which the borrower has to fully repay the principal amount and the interest of the loan. The interest rate could be fixed or variable. A fixed interest rate means that the borrower pays a certain amount every repayment period, while a variable interest rate could lead to fluctuating repayment amounts. Merits and demerits of short-term finance. Merits of short-term finance. Economical. Finance for short-term purposes can be arranged at a short notice and does not involve any cost of raising. The amount of interest payable is also affordable. It is thus relatively more economical to raise short-term finance. Flexibility. Loans to meet short-term financial needs can be raised as and when required. These can be paid back if not required. This provides flexibility, no interference in management. The lenders of short-term finance cannot interfere with the management of the borrowing concerns. Management retain their freedom in decision-making, may also serve long-term purposes. Generally, businesses firms keep on renewing short-term credit. Example, cash credit is granted for 1 year, but it can be extended up to 3 years with annual review. After 3 years, it can be renewed. The sources of short-term finance may sometimes provide funds for long-term purposes. Demerits of short-term finance. Fixed burden. Like all borrowings, interest has to be paid on short-term loans irrespective of profit or loss earned by the organization. That is why business firms use short-term finance only for temporary purposes. Charge on assets. Generally, short-term finance is raised on the basis of security of movable assets. In such a case, the borrowing concern cannot raise further loans against the security of these assets, nor can these be sold until the loan is cleared. Difficulty of raising finance. When business firms suffer intermittent losses of huge amount is declining on or industry is in recession, it loses its creditworthiness. In such circumstances, they find it difficult to borrow from banks or other sources of short-term finance. Uncertainty. In cases of crisis, business firms always face the uncertainty of securing funds from sources of short-term finance. Legal formalities, sometimes certain, are to be applied for raising finance from short-term sources. If shares are to be deposited as security, then transfer deed must be prepared. Such formalities take lot of time and create lot of complications. Relative merits of trade credit and bank credit. The relative merits of trade credit and bank credit are as follows. Trade credit is available only with purchase of raw material or finished goods. It serves a limited purpose, but bank credit can be utilized by the borrower for any purpose that he may have in view. In case of trade credit, payment has to be made after the expiry of credit period. However, in case of bank credit, overdraft, cash credit, etc., repayment after a certain period is not compulsory. No security is required to avail of trade credit. Banks generally ask for some security while advancing credit. Interest is not payable in case of trade credit, provided payments are made within the credit period. Interest has to be paid on bank credit in all circumstances. The terms and conditions of trade credit vary according to the custom and usage of trade. Bank credit is granted on the terms and conditions which generally are the same for all types of business. Advantages and disadvantages of bill discounting. Advantages of bill discounting. Immediate availability of cash. By discounting the bill, the drawer gets cash immediately. He does not have to wait for the payment until the expiry of credit period stated on the bill. No extra security is to be offered. Banks generally do not ask for any other security while making payment against the bill discounted. However, if a customer is interested, banks also grant him limit for discounting of bills. This limit is known as limit against discounted bills. Nature of liability for repayment. Repayment of money advanced against discounted bill is the responsibility of the drawer of bills of exchange. Banks therefore approach the drawee, who is generally the acceptor of the bill, for payment after the due date on the bill. Disadvantages of bill discounting. Payment of interest in advance. While discounting a bill, bank deducts the discount and balance is credited in customer's account. This discount is equal to the amount of interest for the remaining period of payment against the bill. Thus, the person receiving money through discounting of bill has to offer advance interest on the amount of the bill. Facility is subjected to the credit worthiness of parties involved. Banks generally extend this facility after being satisfied with the credit worthiness of different parties involved. In case of doubt, the bank may ask for some security. Thus, it is not a very easily available facility. Additional burden in case of non-payment. Bills not paid upon maturity are to be certified by notary public and a certain amount in the form of noting charges is paid. Thus, it becomes an additional burden. Summary. Let us now summarize what we have learned in this section. Short-term financing is that form of financing which embraces borrowing or lending of funds for a short period of time. The matching principle of finance is a standard theory used to explain the amount of short-term debt, financing and other current liabilities that a firm has on its balance sheet. Medium-term and long-term financing are also customarily referred to as financing. Short-term loans help business concerns to meet the temporary requirements of money. Installment credit refers to a loan of a credit amount that the borrower gradually repays by making regular payment.